Let's look at types of loans. There are basically three different types of loans: bridging loans, mezzanine finance, non-recourse loan, or debt. Bridging loans, I've already taken one. I have taken one. It is used to quickly move on a deal. So if you got something and you don't have finance to cover the complete purchase, you go and get a bridging loan, and typically refinance after a short term with another lender, which comes at a higher interest rate, often used to obtain planning permits. So once you've got the permits, you go to another bank and say, okay, let's just finance this, and comes from specialized lender willing to take the extra risk. So that's a bridging loan. Mezzanine finance, something that I would discourage anybody to get into because the requirement for mezzanine finance would actually come if you are not well planned. So I would discourage you to do that because it comes at a very high interest rate. Debt capital, basically debt capital that gives the lender the right to convert to an ownership or equity interest in the company if the loan is not paid back in time and in full. So basically they will take over the project. They will take over your share of the equity, or they will take away all the equity or all the profit or whatever they can if they can't recover their debt. So used by developers to secure additional financing for development projects where there is a shortfall of equity required by the main or senior lender. So say for example, I'll give you an example here. You come to construction loan and somehow the valuation comes in very low, and the bank says, okay, no matter what you do, you've got 5 pre-sales out of the 9 apartments, for example. But although their debt is fully covered, the bank does not see enough equity in the land. So they would ask you to put more equity in the project. Otherwise, although they even approve the construction loan, it'll always be contingent upon you putting in extra equity because the valuation came in low. So you got to remember that. And it doesn't matter even if you've got 100% pre-sales. If the banks have this criteria that they've got to have X amount of equity in a project of a certain size, and if they see the valuation does not show that amount of equity, they will ask you to inject more equity. That's when mezzanine finance comes into play, because when you didn't plan for that, the valuation came in low, or by the time it was time to get valuation, the market turned and you had to come up with extra equity. So that's when you would go for mezzanine finance. I would actually prefer getting private funding from friends, family, rather than going to mezzanine finance in that case. However, when you're planning a development, you must have extra reserve on hand depending on the size of development that you are doing, so that if something goes wrong or the valuation comes in low, you still got it covered. So it's more expensive because it's secured by a second mortgage. Since it's second in line, that is, if something happened, first mortgage holder, which is the senior lender, gets paid out first, and then the second lender gets paid. So basically what this is, that even if you went and got private funding or mezzanine finance, mezzanine is basically to fill the shortfall. And whatever you are short with, you'll go and borrow this off a friend, you could borrow this off a lender. So no one will get first mortgage on it, because the main senior lender who's giving you the construction finance will have the first mortgage on it. So because they have the first mortgage on it, you gotta have you can't have you can't have this lender. You can't give this lender the first mortgage. So this one has to settle with the second mortgage. They charge you more interest rate, because if something goes wrong, the senior lender who's financing the construction loan has the first right on selling everything and recovering its money. Once they've got their money, whatever's left is used to pay off the second mortgage holder. Non-recourse loan or debt, not very common, but it is available in the market. It is another option. So basically, secured by collateral, real property, but the borrower is not personally liable. If the borrower defaults, the lender can seize the property pledged as security, but lenders recovery is limited to that property. That is, the lender cannot come after the borrower even if the collateral does not cover the full defaulted amount. So in order to cover that, banks never lose. LVR is only 50 to 60% of valuation. So they will lend you a lot less, and they will make sure that they are covered at all times.